So when clients start with me, I always have them send a couple years of tax returns so we can do some planning work and think about their past tax rates versus future tax rates. I don't know if there's something in the air lately, but I've been seeing a lot more mistakes recently. What I wanted to do today is create a hypothetical tax return and take you through it so you can know the kind of things that I'm looking for, and we will point out the 3 most common mistakes I see on these tax returns. And I think the big problem with these have been really big dollar number mistakes, and they're either creating a much higher likelihood of being audited, and that audit would not go well for some of these clients, and or they are costing you thousands of dollars because of the mistakes. So I'm going to take you through this today, and hopefully you get something out of it. My name is Scott Caulfield. I'm a CPA and CFA charter holder and the founder of Sophos Wealth Management. Okay, so here is the hypothetical tax return. We're going to take a hypothetical single individual, pretty high income. For the purposes of this, we're going to pretend he's a tech employee, making pretty good money. Because it's hypothetical, I use nice round numbers. That would be a red flag if I saw an actual tax return that was all this nice and neat, but let's ignore that for today. So the first thing that kind of stands out, you'd want to make sure of this pension annuity, the taxable amount, $40,000. Was this a distribution? Was this a rollover? Was this actually taxable? That would be the very first thing I would want to check. Next thing, you see the capital gains here. We've got $25,000. That would be something you just want to double check they're doing correctly. And then third thing that really jumps out, big potential red flag here, this additional income, negative $55,000. So we got a huge loss. Is this from a business? What is this from? Anytime you see a really high income person with a really big additional income loss, that's a red flag. So first one is pretty easy. Let's just look at the $40,000 distribution. For this hypothetical client, I know that they did not roll money over to me. So I'm thinking, what is this? And I have one example in mind, but you see this from time to time where you've got these taxable pensions annuities and you just really have to check what it actually was. If we go and look at the 1099-R for this hypothetical return, we're going to see a rollover with a gross distribution of $40,000, the taxable amount not determined box. So then you'd have to figure out what was this actually for. Now, sometimes what you'll see, and in one case that I'm thinking of in particular, it was a mega backdoor Roth. So what the client had done, they'd made after-tax contributions to their 401k, and then they did an in-plan conversion to a Roth. That allowed them to do the mega backdoor Roth. Now, because the initial contributions were after tax, going from after tax and rolling it into the Roth inside the 401k, there is no tax implication to that. There is no taxable amount. However, the custodian generated a 1099-R saying that the taxable amount of the conversion was not determined, and the client had inadvertently put it on the tax return. Actually, their CPA or their EA had done it without figuring out whether it really was, and it showed up as taxable on the tax return. Big mistake. You'll also see this sometimes when somebody takes a withdrawal or when somebody does a rollover from an IRA, they'll get the check maybe sent to them. It will show up as taxable amount not determined, and then that client will put it, or prospect will put it back into an IRA. It should not be taxable if they do it properly. But if they don't know, they don't communicate it to their tax preparer, or they're doing it themselves, and they don't know all the intricacies, it is an easy mistake to make. And in this case, I mean, that's a $40,000 of extra taxable income that should not be there, that you really got to either communicate or have your advisor communicate with your tax preparer. Or if you're doing it yourself, just make sure that you're careful here. The next mistake on this hypothetical return is this capital gain. And I've seen this one a few times. So we see this $25,000 capital gain. If we go look at the Form 8949 where it's reported, here's a hypothetical one. What you're seeing here is you've got a sale of Amazon. Now, the fact that you're seeing the date acquired and the date sold as the same date, it's probably like an RSU in that case. So we got proceeds of $25,000. That's what they received for selling it, and a cost basis reported as zero. Well, if it was an RSU that was acquired and sold the same day, usually the cost basis is almost equal to the proceeds, almost exactly. So more likely than not, In those kind of cases, the gain or loss is close to zero. So I've seen multiple examples like this, and one recently that comes to mind where it looked almost exactly like this, and there was a $25,000 gain that should have been close to zero. You always want to double check capital gains or losses. Look at the cost basis, make sure it makes sense. Anytime you see a zero in the cost basis, really drill down and figure that out. It's not very common that you're going to have a $0 cost basis. This is a $25,000 mistake that's going to show up as ordinary income because this is considered a short-term capital gain. So that is a costly mistake, especially for a high earner in a high marginal tax bracket. The biggest red flag, the $55,000 additional income, or negative $55,000. So that is definitely something you'd want to drill into. If we look at Schedule 1, where that's reported, we can see in this hypothetical case, it's coming from rental real estate, royalties, S-corps, trust, etc. So Schedule E, and a $55,000 loss. So, oh boy, that is very concerning in this case. If we go look at Schedule E, we can see that this is a rental property that had a $55,000 loss. And don't worry too much about the specific numbers. This is just supposed to kind of be illustrative, but here's why this is a huge problem. So if I see rental real estate with a $55,000 loss, anything over $25,000 loss tells you that this person has reported that they are a real estate professional, that they more than half their professional time is spent in real estate. Now, this hypothetical employee and a lot of potential clients, prospects, they've got full-time jobs, not in real estate. Almost by definition, if you have a full-time job that is not real estate, you cannot be a real estate professional. You're not going to put more than half of your professional time into real estate because you're working 40 hours a week doing something else. So that was certainly the case with one of the most recent mistakes. They were not a real estate professional. Even if you're not a real estate professional, you can take a loss on your return potentially up to $25,000 if you meet certain activity thresholds and certain other tests. However, that is income limited. I think it's $150,000. So this client would be way over the income limit. They would not be able to deduct any of their real estate loss. It would be considered a passive activity loss. It wouldn't go away. They'd be able to save it, offset future income from it, offset a future capital gain or sale or depreciation recapture. So it still has value in the future, but the fact that there's a $55,000 loss showing up on this return, offsetting ordinary income today, that is a huge mistake, huge red flag. If the IRS was to look at this, an audit would not go very well. If you took it to tax court, good luck. You've got pretty much no shot. Go read any of the tax court findings of people trying to claim that they're a real estate professional when they have a full-time job. It does not go well for them. So I just wanted to take you through these 3 common mistakes real quick. So hopefully you have some ideas to double check your last couple of years of tax returns. Make sure you're not throwing up any red flags or leaving money on the table like in the first 2 examples. So appreciate if you like this video, subscribe to my channel, and share with anyone else that you think would benefit. Thanks.